Hi guys, welcome back to the channel. Today I'm going to go through my full, with complete disclosure, £44,000 stock market portfolio. In fact, I'm not going to be doing it for you, I'm going to be doing it for Dwell. Dwell does dividends, was a recent subscriber, commented on one of my comments to somebody else's comment, suggesting that he's just subscribed because he's looking forward to seeing the dividend portfolio update. So this is for you as well. Go up to his channel, I'll link it up in one of these corners. Go up to Dwell's channel, just check him out. He's a fantastic YouTuber and goes in real depth when he does stock analysis. He really looks at each stock in a great deal of detail, and a really great guy to follow. So check out his channel up there, give him a subscribe, and follow him along in his journey as well. Couple of quick disclaimers. This is my portfolio, not your portfolio. You should do your own portfolio because I'm doing my portfolio. So do your own research when you're doing your portfolio because I've done my research when I've done my portfolio. Okay, capiche? Good. We're going to get straight into it. So we're going to go straight into the laptop, which is the market's currently live. I'm filming this on the 15th of October 2020. So we're going to go dive straight into the portfolio and we're going to look at each position, and I'm going to give you just a brief rundown why I'm in that position, why I bought it in the first place, when I bought it, and we'll look at whether it's up or down, and I'll give you a brief overview of my portfolio allocation in the different sectors within the stock market as well, because that's a very important thing to be looking at when you're beginning to invest, to diversify your portfolio as much as possible. So let's dive straight into the laptop. Here we are then. Right, we're in the portfolio here. So we've got this is IG, so this is my preferred broker. Go and check out my broker's video there, up in the corner. Trading212 and IG. Trading212 is obviously free for smaller accounts, and I do have a Trading212 account, but IG charges commission on your first 3 trades within a month, but I just much prefer IG, just the way it is. Here's my share dealing account. With these accounts, you can change the name of the account. I've just got it as portfolio. So let's go into the portfolio now. In we head. So here it is. So we're still, oh no we're not, oh, yeah we are. So with my funds that are available that have come in the form of dividends, if you have a look where the cursor is here, the portfolio is at £44,056, and I'm just going to run through each individual stock, why I bought it, when I bought it, and I'll do it really quickly. So Tesla, bought that because there was so much hype about it, and I bought it at a point that it was, I bought it down at, oh hang on no, because of the split it's going to be really difficult to tell you. Effectively I bought it here, I think. It was about $522 when I bought it, and it's up at the equivalent of 2,200 or something. I bought it because there was hype over it. I bought one stock. I thought for the sake of £522 I'd put it in and just see what happens with it, and it's performed very well indeed. Apple, similar situation. Apple's always a good company to get into, and I only got into it just after the dip here. They didn't experience as big a dip as other companies, but got into that in the dip, and then I've bought one more share more recently in the second little dip here at the 122, I bought it at $120 I think, or a bit under, anyway, a bit under that. I'll rattle through these. So Snap, I've sold out of half my position in Snap more recently. It's, as you can see in here, it's 207% up for the money I originally put in at the moment. So head into this, and we've got 8 shares currently in Snap. I had 18, I sold out 10, and we're at all-time highs for Snap at the moment. So bought that right at the bottom. That's one of the best purchases I've made That and when I bought Shopify, I've since sold Shopify because they don't pay a dividend and I'm a dividend investor. That's why I've sold out 10 shares of my Snap position just to reinvest it into a dividend paying stock. Same goes for Facebook. Bought it at a fantastic point back in March, and it's just done one thing since. Facebook is a great company to own for the long term anyway. I own 2 shares of Facebook. This is all in profit and loss order, by the way. Netflix, similar situation, good profit, bought it in the dip. Netflix was only really going to do one thing during a lockdown. You know, everyone's going to subscribe to Netflix and be watching Netflix, so I got into that. And these were all tech stocks, these were all speculative buys, but I figured a lot of them are tech, and tech's going to do absolutely fine in the situation we're in. Uber was a bit of a speculative one because obviously nobody's taking Ubers anymore, but they've got Uber Eats, which I think did very well. It did do very well, that side of the company during lockdown as well. So this is what Uber's doing. I've got 5 shares in Uber. We've got the Vanguard REIT ETF, Real Estate Investment Trust ETF. So they invest in multiple different REITs themselves. So you're not buying just REITs yourself, you're diversifying in REITs. But I'm a big fan of REITs, Real Estate Investment Trust. It's instead of investing in property. So similar situation. So you can see here the little white dot there is where I got in, and it's bounced. It's not even bounced back, it's gone back up, but REITs are, you know, a lot of REITs and a lot of types of REITs are struggling still at the moment. We've got Walt Disney, who I think have just cut their dividends, so I don't know whether I'm going to hold on to those. I need to look into it, but I haven't yet. Similar situation, bought it again in the dip, and it's performed pretty well as well. Disney is something I also own in my Trading212 portfolio, which is a portfolio I share with my fiance. 5 shares in Walt Disney. Let's rattle through those. Procter & Gamble, it's solid company. Don't need to go into that or why I own that. You should all own that, in my opinion. 14 shares of that. I've got 1 share in Wynn Resorts. I've sold out a lot of Wynn Resorts. I bought Wynn Resorts because of a catastrophic dip, and I should have got out really at that point, so I'm not sure where they're going to go with this. In fact, I think I possibly sold out a portion of my position in Wynn Resorts at that point, at the height there. But anyway, so Wynn Resorts, obviously, hospitality sector, still not going to be performing amazingly. We've got 2 Vanguard ETFs, so these are some of my bigger positions. I've got $5,700 in the S&P 500. I add to that on a monthly basis, nearly a monthly basis, just a share here, a share there. And the Vanguard Total Stock Market Index Fund. So the Vanguard S&P 500 tracks the S&P 500, so the top 500 companies in the USA. The Total Stock Market Index Fund invests in about 3,000, I haven't checked them all recently, but it was 3,000 companies. It's a well diversified total stock market index fund. The clue is quite clearly in the title, and I have $4,800 in that. We're 21% up in each, which is fantastic. And these are the sort of things I will just continue to buy forever and ever and ever. If we zoom right out of here, I'm just always going to buy. I actually bought these. The reason I'm not further up in this is because I bought these back here in October and November 2019 when I really started to plow money into the stock market. It went up and I was like, wow, this is great, this is a good gig, this. And then it plummeted and I bought loads more at the bottom, so my dollar cost averaging, my average price for them reduced down, and now they're up about 21% up, which is great. And I did the same thing with the total stock market index as well. The Vanguard REIT I bought at the higher end anyway. This is where we start to get into a little bit of trouble. Not trouble as such. Store Capital Corporation, that's a REIT, I bought that more recently. Boeing, I bought that again down here in the dip. I bought it there actually, because Boeing is such a massive company and it was speculative, of course, but I figured, you know, if all this blows over, Boeing's going to be absolutely fine, and I've bought a fantastic company at a real good discount. PIMCO Corporate Income Opportunity Fund card in the top of the video there. Bought some more of that more recently. It's an income fund, so check that video out, because then I'll have more views and then I'll get shown to more people, and it's all about that YouTube algorithm, you know. EPR Properties had a great run after the I mean, they really fell apart. Had a great run after the dip, and are pretty much at break even, but they are a very good dividend payer. I've just received some dividends from them, I think. Federal Realty Investment Trust, a dividend, definitely a dividend aristocrat, maybe a dividend king. Really good yield, 7%-ish, 6-7%, I think 7. And another investment trust, which is great. Leggett and Platt, another solid company, great one to own 10 shares of that. We're at break even at this point, so anything below here we're getting into some companies that have not done very well more recently. Chimera Investment Corp, monthly payer maybe, huge dividend yield, we're talking 11 or 12%. Haven't done so well since I bought them, but that was a slightly more recent purchase. Pfizer, fantastic all-round company in the healthcare sector, not doing amazing at the moment, but have done very well historically. Dividend payer, and a very good dividend payer. I think definitely an aristocrat. I'm not sure if it's a dividend king or not. Where are we? Let's keep going. So ASML Holding, not a lot to say about that. Only one position in that. $386. Oh no, I've been through that. Bear with me. ACM, Annaly Capital Management. Another fantastic dividend payer. I own 50 shares of that. Again, not very expensive. So $364 in it. We're down on that at the moment. O, ticker symbol O, the dividend monthly payer, or the monthly dividend payer, I don't know. They've labelled themselves something that is exactly what they are. So they pay monthly dividends. It is a REIT. It is probably the most famous REIT there is. I bought in a small dip. I thought, oh wow, look at that, great time to buy, and then it continued down. Is what it is, but a solid company, great to own for the long term, and I will keep adding to that position. We have Ultra Group, Dividend King, Tobacco. I made a video of when I bought those, why I bought them, so check that video out as well. The Geo Group, another REIT. So I've been investing in REITs quite heavily recently. Really good yield. Very small position in that, 26 shares of that at $282. AGNC, that's a mortgage REIT, a monthly payer, fantastic dividend. Did cut their dividend, I think last year or this year, last year I think, but a monthly payer, and it's still a very high dividend anyway. Here we're getting down to the lower ones now, so lost a lot of money on a lot of this. WX is a kind of not a startup as such. It's kind of a tech company. That one was on a bit of a whim, I'll be honest. It was a bit of a speculative buy, and it was a recommendation from somebody, and this is what you shouldn't do. So I've got into this company thinking, oh, it's a recommendation, I trust these guys, let's go into it, and it's not performed very well, and I've got $600 in it. I'm just gonna sit on it, hold it. I did do a bit of homework after I bought it, and it seems like a pretty well-to-do company with some good growth potential. It's just not doing very well at the moment. Iron Mountain REIT, did a video when I bought those. Data Storage REIT, Carnival Corporation. This was a real spec buy. So bought this here, continued down, came up, continued down, came back up, came back down, came back up to massive highs. I was like, this is great, we're getting there. Came back down, came back up, came back down. So that just you know, again, I'm just going to hold that massive company, biggest cruise company, pretty much, or one of the biggest in the world. If anyone's going to bounce back from this, it will be them, and they are potentially up to a $35, $40, $45, $50 company, and I bought them down at 15. So at 45, you know, we could potentially triple our money there. But I don't have a lot in it. I only have 12 shares at $167. Simon Property Group, another REIT, bought it in the halfway down the dip. There we are, 2/3 of the way down the dip. What else have we got? ExxonMobil, getting into a bit of hot water more recently, but a seriously good dividend payer. Got nearly $600 in that. Just been feeding into that bit by bit. Anytime I get some dividends, I've been reinvesting it back into some solid companies like ExxonMobil. AT&T, one of my favourites, always has been. Massive yield, massive dividend. Solid company, always has been increasing their dividends for the last 36 years, I think, around that. I will keep adding to that. It's quite a big position now, got $3,000 in that, so quite a big position. Moving on, Bank of America. I bought Bank of America. I'll be honest, I bought Bank of America. Again, this is a long time ago, and I really started kind of ploughing into the stock market. I bought Bank of America because I heard a story come out from a trustworthy source that Warren Buffett was applying to increase his position in Bank of America, because he owns so much of it. He has to apply and almost ask permission to be able to increase his position in it. And I thought, well, if he's wanting to do that, there's something going on here. You know, Warren Buffett's doing it, and it did. To be fair, it crept up. And I think all the banks and all the finances, you'll see in a minute, are struggling at the moment. So that's why I bought that, because Warren Buffett was. Again, you shouldn't do that. You shouldn't buy something just because Warren Buffett is, but I did. Ventus, REIT, Apple Hospitality, REIT. Got a reasonable position in both of these. Did a lot of homework on these two, just as I bought them. Looked like pretty well-to-do companies. Had good history, good income. Were going to be in it for the long haul. And then pandemic has just really made them suffer. So we're just going to hold those positions. We're still receiving dividends from Ventus. I just had that. Apple, I'm not sure if they're paying dividends at the moment. I certainly think either them or Enterprise Products Partners have suspended their dividend, but I'm just going to stick with it. I'm 30% down in Apple Hospitality Real Estate Investment Trust and Corporation. I'm $930 down in that. Just going to hold it. A couple of UK companies, legal in general, a finance company, insurance, bits and pieces like that. Great dividend payer, really 30% down in that. Vodafone, I'm pretty sure I bought back up here when things were all rosy. Oh, I bought them way back here. Crikey, big position of Vodafone, bought them all the way back here or there. You know, so it's just a long-term hold. They pay a dividend semi-annually. So when I do get paid from them, it's £70-80, which is great. It's quite a big position as well. You might not be able to see to the bottom of these ones down here because I can't scroll up any further, but I'll let you know what they are because my ugly mug is in the way. So Vodafone. So right, you can see this bit. So this one that's 33% down is Enterprise Products Partners. So again, massively down. Monthly payer, I'm pretty sure. I should know this, but I've got so many holdings, I can't never remember all of them. Oh, I think we looked into this. I don't think it is a monthly payer, but it had a fantastic yield. And at the time of buying it, I did some homework on it. It was a solid company. Its earnings were good. It was solid for the long term. And then obviously pandemic has not allowed them to perform as well as they could. The 48% down is HSBC, you can see it there. So not only did it plummet around kind of March time, can see the data at the bottom here. It's just continued to just perform so badly. Banking sector. I did a bit of homework on it a little while ago, and I can't remember what there was some sort of scandal, and not scandal, but you know, a lot of the finance sectors, a lot of the big banks were laundering money and all sorts. But anyway, just poor performer. Still paying a dividend though, I'm pretty sure. So you're just going to hold on to that, just see it out, because the banks at some point will recover. 54% down is EasyJet. You know, and even then I bought it down here at a diff. I bought it in the highs. Crikey, I'd be even further down. And even already I'm 54% down. So EasyJet is a UK, for any American watchers, if you've made it this far. EasyJet is a UK airline, one of the biggest budget airlines in the UK. You know, great, about a 5 or 6% dividend yield. Really good company, great prospects, been around for a long time, great earnings, I'm pretty sure. Did some homework when I bought it. But as you know, everything that's going on at the moment, they've not performed, or they're not currently doing very well at all. STM Group, terrible purchase, worst purchase of my whole life, I think. Went into this without doing a single bit of homework. Basically my thought process behind it, you're not going to be able to see that far. Right, basically my thought process behind this one when I bought it was it was trading up at, so it's 27, it's not £27 or $27. What is it? What would that be? It's not that many shares, 279, this is in pence, so it's like 27p? I don't know, can't remember. Anyway, the 27 here that it's trading at the moment, 27.48, it has been up to 600. Back in 2002, it was at like it was trading at 600. It was a huge sell-off, crash, dip, whatever you want to call it. And then it was trading at like 50, 60, 70, whatever it might have been. Or even these levels, I can't remember. And my thought process was, well, if it has been a 600 pound stock, £6 stock, £60 stock, I don't know, I can't work it out because it's all in pence in the UK stock market. If it has been up to the 600 levels, surely it's got to be able to get back up there again. But no, I don't think it will ever get back up there again. It's paying a £2, around £2 every quarter in dividends, and I have £75 currently in it. I bought 70, I'll do it quickly now, 70 times 279 divided by 100. Yeah, so I put 200 quid into it. So it's just in pence, so it's divide everything by 100. So I put £200 into it, and I get £2 every quarter, pretty much. So we're getting 8 quid a year. So it's gonna take me 24 years to earn my money back if I just leave it in there. And it might go up, you don't know, but I'm just gonna sit on it. It's 200 quid, I don't need it, job done. Right, now we get to this 80% down one. 80%, Luckin Coffee. For those of you that don't know, I have explained this before in some of my other videos. Luckin Coffee is a Chinese coffee company, brand, franchise, who had more coffee stores, outlets, cafes, I guess you'd call them, than Starbucks, or at least as many, or nearly as many. But it was up there with Starbucks, and it was pipped to be the next Starbucks. It was growing to that point. Nobody had ever heard of them over here, but Chinese company had been doing extremely well and just gone public, I think, by the looks of it. 2 days after they went public, no, 2 days after I bought. So if you have a look here, if I zoom right in, that little white dot is where I bought. So literally that day there is where I bought them. That day, nothing happened. And the next day they opened down here. which was like 90% down. And I know it isn't, but anyway, I was like 90% down. Basically what happened is there was a scandal came out that they were smudging their sales figures and they weren't making nearly as much money as everyone thought they were. So 2 days after I bought them, they dropped down 90%. As it stands, I'm a hold on them. I think I had 200 and that's what they're worth now. That's the value right now. I think I put about £250 into it. So I don't know what that is in dollars. Yeah, it would have been because I'm $250 down and they're worth 60, so that's 310. So it's about 250, 240, 250. So 300, 310 dollars is what I put into it. STM I class as my worst buy ever because I did zero homework on it. Luckin Coffee, I looked at all the research and some websites and I did some homework on it. So it's not my worst buy because nobody saw this coming. STM Group was my worst buy because I didn't know homework on it and there was clearly no prospects it was going to get back up to the levels, and I bought it for the wrong reasons. Luckin Coffee is it's just bad luck, I guess. So anyway, I've rambled on so much that quite frankly I've gotten bored. So that's my full portfolio. I'm sorry you can't see these ones just behind my face, but I've opened them up and shown you. So that's my full portfolio. My favourite stocks in this portfolio are probably AT&T, which is looking like a pretty good buy at the moment at under $28. And probably AG&C because it's a monthly payer and it's been very consistent since I've owned it and it pays me. I've got a good healthy position in it. Nearly $3,000, or it is about $3,000 that I put into it. So I get a reasonable amount. I get about 15, 16 pounds, nearly $20 every single month consistently, which I can just plow straight back into the markets. AG&C and AT&T are probably my favourite buys. I would strongly suggest always buying and going into Vanguard index funds or any kind of index fund. There's loads of them out there. Vanguard is my go-to. They're my preferred index funds, so I drip into the Vanguard index funds on a monthly basis as well. And we've got some speculative tech stocks up here, which have obviously done very well during the situation we've got going on at the moment. So I'll quickly fire you into the dividend payments spreadsheet that I showed you the other day. This is the most basic of basic. I don't track on here certainly where the dividends are coming from. I just go into the history here. So if you go into IG, you can go into history, you can go check full history. You can then do the last, so if you look at the last 24 hours, show me dividends, show history. It's as simple as that. So I've had 2 dividends coming in at nearly £8 today. So that's how I track and see where the dividends are coming from. This is purely just to see progress. It's more a visual, so I can see the line going up, and it's actually more of a psychological thing in truth. If I can see this going up, then I know it's going in the right direction, and I will quite comfortably and happily keep putting money into the stock market. So £90 so far for October, which is good. We're halfway through the month. I'm not expecting loads more. I want to get up to maybe 120, 130 would be good. So that's where we are with the dividends. As I showed you in the 1,000 dividends so far this year, if I highlight this year so far, which again you can't see because my face is in the way, this year so far we've got 1,020, basically £1,020. So doing really well with those. Right, this next page I'm going to show you, Google page, is not up to date. I want to stress that because otherwise you'll comment going, oh, I saw a load of stocks in that allocation sheet that aren't on your portfolio. No, they're not, because it's not up to date and I haven't got it up to date. But this is important for any new investor to have a look at. I kind of know what I want to be going into at the moment. I'm diversifying as much as I can. I'm going into a lot of REITs at the moment and index funds to diversify, and I'm also looking at other sectors to further diversify my portfolio, but to make it a relatively a sort of slightly defensive dividend portfolio in a way. So looking at a lot of consumer staples. REITs obviously aren't really very defensive, but index funds are, and you get some quite good dividend paying index funds. Anyway, this is what it looks like. So these are your, see, I've got nothing in materials and utilities, so that's how diverse I am really, not very at all. So these are the sectors of the stock market, and these are what I've a breakdown of what I've got in each thing. So real estate, I've got quite a large sum. The index funds, I've got a huge portion of that pie. What else have we got? I've got a relatively large portion in financials, which was a good way to go before everything going on, but HSBC is massively down, Legal & General's down, Bank of America's massively down, so that's not doing very well at all. I've got a reasonable section of the pie in consumer services as well. So a lot of your tech stuff is in here. See, even Shopify is still in here, and I don't own that anymore. So a lot of your tech stock is in here. AT&T is in here, so that's quite a big portion of the pie as well. But if you want to have a look at that and go, right, well, I'm going to buy a load in here because they're always going to do well. Certainly in the moment, I'm going to buy a load in consumer staples. Consumer staples are a necessity, like your Walmarts, they're going to do well. I'm going to put a little bit into tech, because it's a bit more speculative, and people are talking about the tech bubble at the moment. I'm not sure I fully believe that. People thought the stock market was going to crash for the last 10 years and it didn't. Real estate, I've got loads in real estate because I love real estate. You should have loads in index funds and ETFs, more than I have got at the moment. That's why I'm still just drip feeding that to build that up each month. A little bit in healthcare, a little bit in energy, a little bit in consumer discretionary. Financials, yeah, fine, good to be in, I guess. Just depends on what's happening in the world. And consumer services. So it's important to diversify the portfolio as much as you can. And this is kind of my breakdown of it, I guess. So it's easy enough to produce something like this. This is the most basic of basic, but it gives you an idea of kind of how diversified you are, really. So anyway, that's kind of the portfolio. That's a rundown of where I am with things. That's a rundown of my dividend payments. That's a rundown of the allocation and what you should really be looking at in terms of where your money is. And that is, we're still at 44,000, and that is a breakdown of my portfolio there. So that's it. Oh, I nearly fell asleep during that. That was so boring. Well, if you made it this far, I mean, amazing. The market looks like it's about to close. I'm going to throw you back. It has closed. I'm going to throw you back out there for a outro. Alright guys, so I hope you enjoyed that. I hope you got a bit of value from that as well. I hope that's opened your eyes a little bit as to just stock market investing in general, dividend investing in general, maybe some of the companies that I'm in general. And hopefully it's inspired you to sort of get yourself into the stock market and start investing as well. That's the whole kind of drive behind this channel, really, is trying to share it. I've only really been investing for not that many years at all, really, and I absolutely love it, and I really think it's the way forward for a lot of younger people. So I'm just trying to drive that message forward. As I said earlier in the video, go and check out Dwell's YouTube channel. Dwell does dividends. Great channel to be subscribing to as well. Talking of subscribing, get yourself subscribed to this channel. Give the video a like if it has given you some sort of value. That's what I aim to do with these videos, give you some sort of value, really. Pop in the comments below where you at in your investment journey, what your portfolio is at, how much you're investing each month, what your favorite stock is at the moment, and we'll have a talk about it. That's what this community is going to be all about, which is good. So with all that said, hope you enjoyed the video, and I'll catch you guys in the next one. See you later.